All right, good morning, and this is Half May with a Legal Play.
And I am Chelsea Elazzi, Hat May's associate. And I guess this month, Elf. We're, we
Ho, ho,
are
ho.
we are doing end of year theme this month, and today's topic is end of year tax planning
Yes,
with a twist.
yes, we'll have a few twists, as a matter of fact, in the process. This is, I guess, gifts from Santa Claus is the theme that we can do with regard to this.
We like giving back to our client base.
You know, the U.S. tax system and most other tax systems kind of work on these annual reportings. The general idea is you pay money on you pay taxes on your income, but income is not necessarily one of those things that are fixed. I guess people that are used to getting a paycheck every Friday or
Every 2 weeks.
every 2 weeks or every half month or something like that kind of have a better concept of the time than a lot of other people do. But there are interest that accrues over time, but is only taxable when paid.
Yes.
There are bills that accrue, but only deductible when paid. There are investments that appreciate, and some that don't, and some that lose money in the process. But it's not really considered taxable until such time as a transaction, usually a sale or other disposal of those particular assets are done, and then there is a gain or loss recognized in connection with that, and
in the year that it happened.
In the year that the transaction happens, sometimes, and then there's some rules that says no, but you can do an installment sale if you do it on a finance type arrangement, or if it's real property that qualifies, you can reinvest it in something else, do a 1031 exchange and defer that gain. So although we tend to say we're going to file these annual returns, there are events in our life that don't fit nicely and neatly into a particular year.
Okay.
Which creates an opportunity for taxpayers to kind of plan around what year events occur, or if they're spread out over several years, so it fits some sort of tax planning or to match it for their income, or just to stay below the top tax rates.
Okay, so we're coming up on the end of year. What do we need people to know?
Okay, one of the first things you need to know is you gotta need to have an idea of where you are to start. I don't know how many people I've known that don't keep good books and says, gee whiz, I need to do something to plan for tax year end. And then they wind up over planning, paying too much, deducting too much, maybe buying more equipment than they really needed. And then only to find out, well, gee whiz, I didn't make as much money as I thought I had when I came to see you on December 1st. So I didn't need all that deduction. So keeping in mind, where you are and knowing that is good, because it can help you plan and figure out, okay, if I need deductions, but how much in the way of deductions I need. If I need to defer income, how much income? Those are all important things to do.
Okay. And so you've got some tricks of the trade. You've been doing this for a while.
Yes, into the 41st year, I think it is. But yes, that's and I'll still be doing it a few more.
Okay, so we're coming up on the end of the year, and I guess our twist is extending the tax year.
Well, that is a twist. But before we get to that, let me just kind of go through some of the standard things that don't necessarily have the twist. They're just kind of standard year-end type deductions. That is, if you're a cash basis taxpayer, look at when you're likely to have collections with income. And if there's a way to legitimately defer that, perhaps completing a job, sending an invoice that will fall to get paid the next year, that can help defer income. Also, take a look at what sort of bills you have and debts that have accrued that you would normally pay on January 1st or January 10th. Try to pay them beforehand. A lot of these for individual taxpayers, not just business taxpayers, but do you pay your taxes in December or January, depending upon where you are? If you need the deduction and are still within limits, pay them in December. That mortgage payment that accrues and is due January, really accrues for the month of December, you can pay it in December and get the deduction for it
Okay.
in December. Also, a series of different types of retirement plans that you can have as an individual or as a small business person that you can make these contributions and get deductions for it. And there's some tax breaks for that. So that's something that should be considered in the meantime. And those are kind of some of the standard. One of the things that has developed in recent years, and it's been around before, but is there was this thing called bonus depreciation, where somebody that is in business can buy essentially equipment or other personal property and take a big first year write off on it. Up until last year, 2022, you could deduct 100% of equipment purchase up to a pretty high limit, seven-figure limit. But now it's only 80%. In next year, in 2024, it'll be 60%, and it's phasing down as we go forward. But buying equipment, buying things for your business, even if it's a small business, can qualify for a deduction in this year, 2023.
Great. Those are good tips.
Yeah. So some of the real twists, though, what you really want to hear.
Well, there was a good one that you told me about the other day that I figure.
Yes, and this dealt with selling an asset. And I actually did this transaction, and somebody who doesn't really know whether they want the typically income in this case to fall in 23 or 24, because there are too many unknowns with regard to that. Can engage in a transaction that I developed about 10 years ago, whereby they can engage in a transaction and then have until about March 15th to figure out whether they want to undo that transaction.
Now, I feel like having some background as to why this was necessary is helpful. There was some kind of legislative, there was a bill that was getting ready to be passed or something that made it kind of unsure what the tax situation was going to be.
And that was one of the uncertainties, sort of what I call a macro, the law uncertainty. And this was the year between 2012 and 2013. Had a client who came to me who had a deal to sell a portion of his business and was going to have a big gain, and like $8 million gain or something to that effect. And the question was, did he want it to happen in 2012 or 2013? What the point of that year was 2013 was the year that the Obamacare net investment income tax 3.8% went into effect. So if the transaction happened in 2013, he would have to pay that 3.8%. Additionally, the Bush era tax cuts, which were relatively low given the history of taxes in the United States, were scheduled to sunset on December 31st.
Of 2012
in the process. So if you paid in 2013, it was likely to be a higher tax rate. Now, what happened was, and the bill to set the new tax rates did not pass until January 1st of 2013. So you could not know in 2012 what the tax rates were going to be in 2013 because Congress didn't act until the next day. And there were some technical political reasons for doing that. There was this contract that a bunch of conservatives signed not to increase taxes. So if they let the Bush taxes sunset, suddenly the taxes were back to what they used to be. And when they passed the bill that made the 2013 tax higher than 12 was, it wasn't a tax increase. So there was this kind of political cover as to why that occurred. But we knew that taxes were, particularly for high income people, were going to be higher. And in truth, it wound up being that because there was a 15% tax rate in maximum tax rate in 2012, and it wound up being a 20% maximum capital gains rate in 2013. So it was advantageous. We knew it would be advantageous to do it well if the transaction really occurred. That was the one uncertainty, the sort of legal, macro uncertainty. The other uncertainty was we didn't really know whether the deal was going to go The deal was actually going to be funded and paid in 2013.
Okay.
So we didn't really have the ability to, say, well, okay, we're going to do it in 2000, we're going to do it in 2012 because the funds wouldn't be there. But what we did is create a transaction in 2012 where we formed a corporation and the individual sold his stock to the corporation. And that was the first transaction. We did that like December 30th of 2012. So it would be well within that. And the trick to that was, that was a transaction that if in fact a individual sells his stock to a corporation, and not a contribution that would try to invoke what we call 351, section 351, but it's a way that avoided that. So it would be a taxable transaction, not something you would normally do. Try to create a taxable transaction early. But given these circumstances, given the uncertainties involved, we went ahead and did that. Now, we were to the extent that we wanted to pay taxes on it, we knew we wanted to pay taxes, but there was a risk that the deal would never fund, never happen. Yeah, and when I say that, he formed the corporation, moved the stock to the corporation, and then the plan was sometime in 2013, when the funds were available, to go ahead and have the corporation transfer the property or transfer the stock to the new buyer.
Right. Okay.
And that was the plan. So we're perfectly willing to pay taxes in 2012, but we know we're going to get $8 million in 2013. But we weren't sure of that.
Yeah.
So here's what we came up with. And this is a little technical, so I'll try to go slow. But we formed a limited liability company, which is a corporation and has all of the state law protections that a corporate entity would have. However, the IRS doesn't recognize that. That is an entity which can elect to be a disregarded entity, meaning although it has this state law existence for tax purposes, it doesn't. It's treated just as if it was sole proprietor, sole owner of the stock, and thus whatever income or loss is generated is reported on his Schedule C or Schedule E, Schedule D, wherever it falls, but on his return as if he were the only owner. However, if it is a corporation that elects to be taxed as a C corporation, then that corporation itself is a separate entity. And when he sold the stock to that, it was a real sale. If he sold it, however, to a disregarded entity, selling stock to yourself is not a transaction for tax purposes, and it's as if it never happened.
Right.
The unique thing about this was since we formed the LLC, limited liability company, in late December of 2012, we had 75 days to make that election. So that took us into early March.
When you say make that election, you mean to elect to go from a disregarded entity to be treated as a C corp and taxed as a C corp.
When an LLC is formed with one member, the default, if you do nothing, make no election, is that it's a disregarded entity, as if there was no entity there at all.
Okay.
If you elect a C corporation, then it is its own entity and thus the transaction. So we got to look into, we got about 74, because I guess we did it on the 30th, but into, mid-March before we had to decide whether or not we wanted that transaction to actually be a taxable transaction in 2012 or just a completely disregarded transaction.
Because if you elect to be treated as a C corp, it would have gone back. It would have been a C corp from the beginning. And it would have been a taxable transaction at that point.
Correct.
But if you didn't elect, it would have been just a transaction with yourself.
And then when the LLC sold the stock in 2013, that would make it a 2013 transaction.
Very clever, Mr. May.
Well, it was useful. And I've been waiting for the year in which we know the tax rates are going to go up. It's coming, but I don't, as we sit here in 2023, I don't foresee a big tax increase in 2024.
Do you foresee anything coming up for 2024?
It's an election year. And we used to say tax bills don't get passed in election year. Not true. I mean, it happens all the time. So there may be something, but I tend to think not. I think it tends to be after the 2024 elections. We will have, for one thing, I mean, where Congress is now, it's going to be hard to get much done. It's going to be hard for them to get a budget or to continue to fund the government, much less to pass some new tax legislation. So it's either pro-taxpayer or price raise in the process. That's what's going on there.
But in the meantime, people have their businesses and life keeps trucking along and we're here for you.
We're here. That's the year end is coming. So think about what we said here and do some more research, kind of figure out where you are and think about whether or not you want to move a little income into next year or not.
Well, thanks for your time, Hap.
Certainly. And this is Hap May with a Legal Play.
Ho, ho, ho.